Hi everyone, good morning and welcome to JAIIB CAIIB English Medium. My name is Aarti and today we are going to conduct Module C and D mini marathon especially for June 2025 ABFM exam. Now first up, we are starting this session, I would like to request you that please confirm me about the audio and video quality. I hope I'm audible, I hope I'm visible. Please confirm me once so that we can start this session. Hi everyone. Please confirm me once about the audio and video quality. Good morning everyone, good morning. Chaliye, so I think then we are good to go. Okay, and remember one thing, though now I'm starting this session, but try to give me your answers. Okay, whatever you think, like this is your correct answer or that is your correct answer. Try to interact with me, try to give me the answers, whether that is correct or wrong. That is a secondary thing. But first, try to give me the answers, try to solve with me, because today again I'm going to give you numericals as well as theory questions. Correct? Chaliye. So let's start this session. Okay, thank you so much. So this is our first question. Everyone, the Black-Scholes model is primarily used for the valuation of which of the following financial instruments? A. Equity shares and debentures. B. Options and warrants. C. Bonds and fixed deposits. D. Mutual funds and exchange-traded funds. Basically, this question is from your Module D. Your Module D first unit, that is hybrid finance. Correct? Under this, we have seen that whenever you are taking the funds, and in that funds, if you have these two qualities, that is equity plus debt, then you are going to call it as what? Hybrid funds. Now, under this, you have different options. Correct? Like, you can take here that convertible debenture. You can go with the convertible debentures. You can go with the warrants. Okay, these are few examples that you are going to see under this particular hybrid finance. Now this question is from this warrants only. Now under this warrants, we have seen one method, that is Black-Scholes model. Now warrants means what? Warrants means in this you are receiving the right. The right for what? The right that you can purchase the equity shares at predetermined price. So this is the document, the certificate you are receiving, correct, when you are purchasing the warrants. So in this particular method, you can use the valuation for the warrants as well as the options. This is the method, this is the model through which you can value it, and this is the continuous question they are asking from each and every attempt. Okay, you can see in previous attempt also, in alternative attempts also. This is one of the very important topic, that is Black-Scholes model. So warrants, you understood. Now options. Options gives you the right that you want to purchase the shares or not. Okay, so right to purchase. So here you are going to see the call option, right to purchase, whether you want to purchase it or not. That is totally based on you. So this is the right you are receiving under the options. So you are going to use which model? You are going to use Black-Scholes model for calculation. So the correct answer is answer B. Chali, coming to the next question. In project finance and investment, what does the hurdle rate primarily represent? Now this is again your previous year topic on which they have asked the question. A. The maximum acceptable rate of return for a project. B. The rate at which the NPV of a project becomes 0. C. The minimum annual return measured as an internal rate of return that a fund is required to guarantee for its investors. D. The discount rate used to calculate the present value of the cash flows. Can you tell me which is the correct option here? In this particular question, they are asking about the hurdle rate. Now, what do you understand with the hurdle rate? See, hurdle rate is the minimum amount that you need to generate, correct? Now, in which particular unit we see this hurdle rate? So you are going to see this hurdle rate in your that private equity venture capital. Correct? In that you are going to see different analysts, there you are going to see the roles of under the venture capital. Now in that, whenever you talk about the limited partners, correct, so they are required to receive the minimum amount of guarantee, that at least if you are investing in this particular startup, so we are going to receive the minimum amount of guarantee. So that is what your hurdle rate is, the minimum annual return, correct, required, measured as an internal rate of return that a fund is required to guarantee for its investors. So this is from your, again, private equity and venture capitalist. Okay, and what do you understand with the private equity? In this, they are giving the funds to the established companies, not any new type of a company. Okay, so they are giving the funds to which type of companies? To established companies. Correct. Whereas if we talk about venture capitalists, so venture capitalists, they are funding again, but they are funding in startups. Correct? Startups. So this is the difference between venture capital and private equity. Private equity includes the venture capital, but venture capital is not funding to the established companies. They are funding only to the new companies who are having the innovative ideas, who are supporting, who are generating the employment. Correct? And that we have limits for the startups. If they are following that limits, then they are going to be considered as startups. And here the correct answer is answer C. Chaliye. Coming to the next. Which of the following best describes the primary function of prescriptive analytics? A. To analyze past performance and identify trends. B. To forecast future outcomes based on historical data. Then C. To recommend specific actions to optimize future results. D. To summarize current operational efficiency. So you have 4 options and you need to identify the correct answer for the prescriptive analytics. Now, this question is from your business analytics, again module D. Okay? In exam, you can see case study based on this types of analytics. You can see individual question also like this. So let's understand different types of first analytics. So we have basically 4 different types of analytics. Correct? Chaliye. So we have the first one, that is your descriptive. You have descriptive, second is your diagnostic, correct? Then third is your predictive, then fourth is your prescriptive. So this question is based on this 4 type of analytics. Now if you see these two, okay, these two, descriptive and diagnostic, these 2 types of analytics talks about the past. Okay? I'm just giving you one overview. If you're confused in this 4 types of analytics, then you can take the help from this particular chart. That descriptive and diagnostic, these 2 things talks about the past. And if you see next 2 things, that is predictive and prescriptive, these 2 things talks about your future. Correct? But now, specifically what they are talking about, let's talk about that. So descriptive talks about the problem. Okay, what are you facing right now? What are the problems? Correct. In this, they are going to use your past and they are going to find out your problems. Then next, diagnostic, reason for those type of problems. What are the reasons you can see that lead to these problems? That is what diagnostic talks about. Then you have predictive. Now this talks about the future. Now based on your problems, reasons, you are now understanding about the future. Are there any chances the same thing going to repeat? Correct? So that is what we are seeing in predictive. In predictive, we are analyzing the future outcome. The future outcome. Now, how you can control, or you can say the remedy, correct, to make sure that again the same issue might not again come. So this is what prescriptive. So if you read again, we are not talking about past, this is wrong. To forecast future outcomes based on historical data, no, that is the predictive, correct. Then to summarize current operational efficiency, no. C, to recommend, correct, to recommend specific actions that we can take to resolve the issue. So the correct answer is what? Answer C. I hope you understood this. Chali, next question. Now remember one thing, in your ABFM exam, they can ask the questions based on sections also. Okay, chali. So this question is based on your section 47 of the Companies Act 2013. Under what specific condition do a class of preference shareholders gain the right to vote on all resolutions placed before the company? A, if the company defaults on paying interest on debentures for 1 year. B, if the dividend in respect of their class of preference shares has not been paid for a period of 2 years or more. C, if the company undergoes a change in its management structure. Or D, if the company fails to achieve its annual profit targets for 3 consecutive years. Sorry. Now please tell me, what do you think, which is your correct answer? Yes, as I can see, so many of you are giving right answers. So tell me. Okay, I got the answer from Madiha ji. And what about others? What about others? Try to participate. And if you are watching in recordings, then please try to identify the correct option. Correct? Which is the correct option as per section 47 of the Companies Act. Now, let's talk about first about the preference shareholders. Correct. As the preference shareholders, what are the things they are going to receive? What are the features you are going to receive? First thing, that they are going to receive fixed dividends. Correct? They are going to receive fixed dividends, as well as they receive the right to get the preference right over equity they receive at the time of liquidation. Correct? These are the few features, and one more feature you can see, generally they are not receiving any right to vote. Correct? No voting rights also, you can say. No voting rights you are giving to shareholders. But as you can see, you have one condition here, to give them fixed dividend. Hana? And if as a company you are not providing fixed dividends for 2 consecutive years, means continuously if you are not providing, correct, if continuously like in year 24-25 and 25-26, if you are not providing dividends, then you need to give the right to vote in your company's whatever the agenda or whatever specific laws you want to implement. So that is what this section 47 talks about. Section 47 talks about if the dividend in respect of their class of preference shares has not been paid for a period of 2 years or more, you need to give right to vote to which type of a shareholders? Preference shareholders. So the correct answer is option B. No, not C, sir, because here you are giving the right if you are not giving as a company dividend for 2 consecutive years. Correct? Now we have one more section, that is section 43 also you can see. In this section 43, we talks about the types of share capital. Types of share capital. So we have basically 2 types of share capital. That is equity and next is your preference. Correct? Section 43. Section 47 talks about if you are not paying dividends. Then you have section 55. Now, section 55 talks about how you can issue or you can do redemption of shares. Okay? So these are the important sections as per the Companies Act. And you need to remember which type of shares. This is your preference shares. Remember one thing. Okay, chali. Now let's see the next answer. In debentures, you are not never giving any voting rights. See, debentures means what? Let me tell you one thing. Debentures are type of loan. Okay, debentures are a type of a loan. So in that loan, you are not giving any voting rights to them. Correct? Chali. Now, coming to the next. During the idea phase of a business, the quantity of money required is typically low, and the avenues for raising cash are limited, often coming from unofficial sources. Now, which term describes the practice of growing a company using only one's own resources and refusing any outside investment? A. Venture capital funding. B. Crowdfunding. C. Bootstrapping. D. Debt financing. Tell me now, which is the correct option here? So in this particular question, now this question is from your startup unit. Okay, now if you see how the PDFs are available in our virtual library, that library link is available in our description box. You can download it from that. Chaliye. Now let's discuss about this particular question. Now when we talk about the startup, okay, in that we have so many different stages. The first stage is when you have some idea, correct? So when you have some idea, the banks, the venture capitalists, they are not going to fund in your idea. Initially, you need to start your working, okay, by your own funds, by your family's funds, by your borrowings that the people are giving you. So this is the amount you are going to use. So remember one thing here, what we are talking about, idea phase. You just thought about the idea that we can start this particular startup, correct? Now, initially, what I just said, you cannot take a loan. Debt financing means you are borrowing, correct? Debt financing means here you are borrowing. Now, the borrowing you can done from your bank also, but bank will not give you any loan based on just ideas, correct? So this is not your option. Then venture capital funding, though they are supporting, correct? They are supporting the startup companies, but not this much early. They need to at least come into this scale 1. Then only the venture capital fund, this funding will come to you. So this is also not your correct answer. Then you have crowdfunding and bootstrapping. Now see, both the things you can see during the idea phase. Now, crowdfunding, as you can see here, crowd. Okay, so now you are sharing your ideas. You are sharing on digital platforms, and if people like your idea, they are giving you small funds. Okay, they are not the venture capitalists. They are not the venture capitalists. Suppose you just posted on this Instagram. You just posted on Telegram. Now, I like your idea. Though I don't have that much, a huge amount of money. Correct? But I like your idea. I want to share in your company, or I am ready to give you some amount of borrowings. So, this is what crowdfunding is. When few friends, few acquaintance, they are coming and funding you. So, that is crowdfunding, and here we are not talking about crowdfunding. Now, next is your bootstrapping. Bootstrapping means when, as I am starting my startup, okay, if I have idea, I want to start my startup. So initially, I am using my FD amount, correct? If I have any PF account, I will use that amount. If I have any investments, I will use that amount. So as a owner, when I'm starting any startup, and if I'm using my own resources to at least start the working, that is your bootstrapping. Correct answer is answer C. I hope you got the correct answer. I hope now you understood if you have given any different answer that why this is not the correct answer. Correct? You have understood it correctly that venture capital is also giving to the startup now, but under the startups we have different phases. So in which phase this venture capitalists are giving? Not in your idea phase only. They are coming in this picture after few stages. So remember this point. Correct? Now, chali. So this is about your correct answer. That is your answer C. Next question. So when comparing going public through a SPAC merger versus an initial IPO, which of the following is not typically considered an advantage of a SPAC merger? Again, revise this session and please watch the question again. Tell me. So, when comparing going public through SPAC merger and if you are going directly in a IPO, then which of the following is not typically considered an advantage of a SPAC merger? A. Speedier execution. B. Discovery of the price upfront. C. The possibility of raising additional capital. D. Inability to track use. Because in our previous question, in that startup question, I explained all your 4 options also. So please make sure you are watching and listening again very carefully. Which is the correct option here? So, if you see this speedier execution, discovery of the price upfront, okay, the possibility of raising additional capital, all these are advantages. These are the advantages under this SPAC merger. But if you see inability to track use, this is your disadvantage. This is your disadvantage, because as an investor, when you are funding, when you are giving the funds to this SPAC, okay, so here you are not aware the which type of company the SPC will acquire, because SPC will look for the target company and they are not aware correct, in which type of target company they are going, where they are investing if they are not identifying the target company. So that is the disadvantage you can see in your what? In your this SPAC merger. Chali, next. This is again a direct question you can read here. This is the first point from which the question is from. Now, next question. According to IVS 105, which valuation approach is utilized to determine the present or current value of a company's expected future earnings or cash flows, often by calculating net operating income and dividing it by a capitalization rate? A. Market approach. B. Income approach. C. Cost approach. D. Asset-based approach. Now you need to tell me that as per IVS 105, which is the method we use? As per this, we have 3 different methods, correct? First one, we have the market approach, then we have the income approach, and the final one we have, that is cost approach. But as per the given details that you are taking the net operating income and then you are dividing it by a capitalization rate, in which particular method we are doing all this thing? Now let's talk about one by one. So when we see this market approach, how we are valuing the things? You are valuing the things by comparing the asset or business. Okay? Here you are taking the comparative data. You are using comparative business. You are taking the assets, liabilities of any comparative company. And then you are using the market approach. Then when we are going to use this asset-based or cost approach, both are same. Okay, both are same. Now, when you are valuing, correct, you are using here, when you are using the assets and liabilities, here you are going to take the fair market value, FMV, and you are going to take the assets minus liabilities, correct? This is what you are taking. and through this you are valuing the companies. Correct? So here you are going to take the net assets fair value. This is what this is, your cost approach or asset based approach. Now if you see the income approach, now how we use this income approach? Income approach is used when you take companies NOI and if you divide with capitalization rate. Here you are going to take the rate. So the correct answer is answer B. This is direct question based on your formula. Yes, correct answer is answer B. Now you have three evaluation methods, that is market approach, income approach and cost approach, or you can say asset based approach. Market approach, just now we have seen that we are going to use the comparable assets or businesses. Income approach, we are going to take the net operating income by capitalization rate. Then cost or this asset based approach, here we are going to take the value by taking your FMV of the company's net assets. So how you calculate the net assets? You calculate it by assets minus liabilities. And this approach is especially useful for asset intensive businesses or troubled entities. Correct? When your main thing is your assets, then you can use this particular approach, that is cost approach or asset based approach. Chali. Now coming to the next, that is, okay, now we have one numerical question. This is direct question based from your IFBF book. Now this is direct question from IFBF book. So let's solve this. The following financial information is available for company M, an unlisted pharmaceutical company which is being valued EBITDA 500 crores. Now what is this? EBITDA. These are your earnings. But which type of earnings? In this earnings, you have not deducted, I means interest, okay, T means tax, D means your depreciation, then A means amortization. Correct. These things are actually inclusive in this particular earnings. So what we call this earning before interest, tax, depreciation, amortization. Now you have the book value of asset, that is 2000 crores, and you have sales, that is 5500 crores. Now after this what you have? That is the pharmaceutical business E, F and G have been identified to be comparable to company M. So now we want to value what company M, but that company is your unlisted company. So we don't know which is the correct valuation of that company. So what we are doing, we are taking the comparative companies. Correct? We are using the comparative companies. Here we are going to take the business like E, F and G. They are identical. So if they are identical, you can use this type of businesses for the comparison. So to be comparable to company M, based on an analysis of a number of other publicly traded pharmaceutical companies. Now the following information regarding the financial health of these companies is available. Sales, EBITDA, book value of assets, enterprise value. And you have company E data, you have company B data, F data and company G data. So what do you think? What is the first thing we need to calculate here? Any idea? How we are going to start the valuation? So when we are starting this question, we need to start with the valuation of these three companies first, because here you can say the details individually, separately, but we need to convert this and we need to calculate enterprise value this with EBITDA, with the sales, correct, with the book value of assets. So this is how you are going to calculate first the listed companies